Welcome to the deep dive. Our mission today, well, it's pretty focused. We're diving into one of the real powerhouses in European finance. That's the Luxembourg Special Limited Partnership. You'll often hear it called the SCSP. That's the French abbreviation. Société en commandite spéciale.
Yeah, and it's really more than just some dry legal structure. It's designed, really tailored for high-level investment management. We've looked at quite a few sources here. Our aim is to give you the essential shortcut, help you understand why so many international, institutional, and, well, sophisticated investors really gravitate towards this particular setup.
Right, not just a list of features. We need to understand its edge. What really makes the SCSP stand out compared to, say, a structure you might find in the Caymans or maybe Delaware?
Well, the big edge, I think, is regulatory certainty right in the heart of the EU. Now, Cayman or Delaware LPs, they offer flexibility, sure, but they're outside that EU framework. The SCSP gives you enormous contractual freedom. That means real operational flexibility while benefiting from Luxembourg's predictability and regulatory oversight. And that's absolutely vital for institutional players needing EU passporting rights for their funds.
Okay, that EU passporting piece, that's huge for the big funds. And you mentioned flexibility, so it's not just for, plain vanilla assets.
Oh, far from it. This is really the go-to vehicle for alternatives. We're talking major private equity deals, venture capital funds, specialized real estate projects, complex fund-to-fund structures. Basically, if the investment strategy needs speed and a lot of customization, chances are an SCSP is probably involved somewhere.
Okay, let's break down the structure itself then, because this is where that liability protection comes in, which is, let's face it, a core appeal for any investor.
Yeah.
We need to be clear about the two categories of investors needed here.
Exactly. You absolutely need that clear split in function and risk. So on one side, you have the limited partners, the LPs. They're the ones providing the capital. And crucially, they are passive investors. Their involvement is purely financial.
And the payoff for being passive is that shield, right? Limited liability. How strong is that protection, really, for these LPs?
It's pretty robust. Generally, an LP's liability is capped strictly at the amount of capital they've put in or promised to put into the partnership.
Yeah.
So they're personal assets. They're protected. It significantly limits their risk exposure beyond just their investment amount. Think of it like organizing a big movie. The LPs write the checks. They're the investors, but they aren't on the hook if the director, who's like the GP, makes some huge legal mistake on set.
Got it. So LPs provided the path of money, and the general partners, the GPs, they're the ones in the hot seat.
That's right. The GP is the active manager. They're responsible for all the investment decisions, managing the partnership's day-to-day business, handling all the admin. And in return for taking on that legal risk and doing the heavy lifting operationally, they get paid through management fees and carried interest. That's their share of the profits.
Okay, given that risk setup, it sounds like this is really built for a specific type of investor, someone who knows the ropes.
Absolutely. Our sources definitely confirm the SCSP is aimed squarely at professional, sophisticated, and institutional investors. Think large asset managers, big family offices, sovereign wealth funds. It is definitely not designed for your average retail investor.
Right, and for that sophisticated audience, it's not just about direct investments. You mentioned earlier it allows for complex setups, like using it as a feeder fund vehicle. Could you unpack that a bit? What does that mean?
Yeah, a feeder fund structure. Well, it's typically used when you have a big master fund already set up that's the main vehicle doing all the actual investing. The SCSP then acts as a smaller, sort of bespoke vehicle. It collects money from specific groups of investors and then feeds that capital straight into the master fund.
I see. So the master fund handles the investment side, the actual deals, but the SCSP lets certain investors or groups customize how they participate, maybe based on their own tax situation back home or specific regulations they face.
Exactly that. It allows for really granular customization of entry terms, exit terms, without messing up the main master fund structure. And this level of contractual freedom, where things like capital contributions, governance rules, how profits are split, it's all defined privately in the partnership agreement, not dictated by rigid public law. That's a massive attraction.
Okay, now let's get to what you call the real magnet. The cornerstone benefit pulling global capital into Luxembourg.
Yeah.
The tax situation. We have to cover how this works, this idea of tax transparency.
Yes, this is often the core advantage, especially when you compare it to, say, a standard corporate structure. Tax transparency basically means the SCSP entity itself doesn't pay corporate income tax on its profits in Luxembourg.
So no tax at the partnership level. That cuts out a whole layer of taxation right there.
Correct. And that's crucial for avoiding double taxation. Think about it. If the SCSP was taxed as a company, its profits would get hit by Luxembourg corporate tax first. Then, when the remaining profits are distributed to the partners, they'd likely get taxed again as personal or corporate income in their home country. Tax transparency lets the profits flow straight through.
The profits just pass through to the partners, and they deal with the tax based on their own situation. So if I'm, say, a U.S. investor, I just pay my U.S. taxes, and the SCSP is just a clean pipe.
That's essentially the goal, yes. Luxembourg law is set up to make sure the entity itself doesn't add a tax burden, which massively simplifies things for international investors dealing with cross-border compliance. That being said, there is a nuance we need to touch on, something our sources highlighted. While it's generally transparent, there is potential for some limited tax liability, but only on certain income that comes directly from Luxembourg sources.
Okay, certain income. Can you give an example? What might fall into that category?
The most common one is income from Luxembourg real estate. So if the SCSP directly owns and gets rent from buildings within Luxembourg, that specific income is often still taxed locally. That follows the usual international rule. Real estate income gets taxed where the property actually is, but for most strategies, where the assets are global, that flow-through transparency holds.
Right. That clarity is key for sophisticated investors, so the tax efficiency is clear. But let's shift to operations. Beyond tax, why go to the trouble of setting up specifically in Luxembourg? What does the jurisdiction offer operationally? Speed, utility.
Well, Luxembourg has really built an entire ecosystem around these types of investment vehicles. The first big plus is that sheer legal flexibility we mentioned. You can tailor almost every detail, governance, liquidation rules, you name it, specifically to what the partners need and want.
Okay, customization is great. But in high-stakes investing, timing is often critical. If a fund needs to jump on a market opportunity, how fast can an SCSP actually get up and running?
This is where Luxembourg really stands out, especially if you compare it to more heavily regulated EU fund types like, say, a SIF or a SICAR. Our sources consistently point out that an SCSP can be registered and basically active, ready to go, in a remarkably short time, often less than 30 days. That speed allows for really quick capital deployment, which is a huge advantage in fast-moving private markets.
Wait, hang on, less than 30 days. To launch a sophisticated investment fund, that sounds almost too efficient. What's the catch? Is there enough regulatory oversight to make sure this isn't just, well, cutting corners?
That's a fair question, and it gets to a key distinction. The speed isn't really about dodging regulation. It's about the SCSP's specific target audience. Because it's aimed only at professional and sophisticated investors who are presumed capable of assessing risk themselves, it doesn't need the pre-approval from the financial regulator, the CSSF, that funds targeting retail investors have to go through. However, and this is important, if the SCSP falls under the scope of the AIFMD, the Alternative Investment Fund Manager's Directive, then the manager of the fund still needs to be authorized and regulated. So there's definitely a layer of institutional compliance there.
Okay, that makes sense. Speed for the pros, but regulation on the manager side. That balance is critical. And thinking about family offices, high net worth individuals, I imagine privacy is also a big consideration for them.
Absolutely. The SCSP structure can offer a significant degree of privacy. While the entity itself has to comply with regulations and file annual reports, the actual partnership agreement and the specific details about who the individual partners are and how much they've invested that information generally doesn't need to be made public. It helps keep investment strategies confidential.
Okay, let's talk about the day-to-day running administration and governance. The partnership agreement sets most rules, but what are the absolute must-haves, the non-negotiables required by Luxembourg law?
Right, there are essentials. Every SCSP has to maintain a physical registered office in Luxembourg, and they need a mandated administrative agent within the jurisdiction too. This just ensures there's a local point of contact and that they're meeting all the necessary local legal and administrative requirements.
And management-wise, you said the GP runs the show day to day, but can you add layers of supervision?
You can, yes. While the GP handles operations and investment calls, the SCSP structure is flexible enough to allow for extras. Often you'll see a board of directors, or maybe a supervisory board, included. The job of this board is essentially to oversee the general partner, offer strategic advice, and basically add another layer of checks and balances tailored to what the limited partners want.
Right. And finally, the perhaps less exciting but essential bits, compliance and disclosure.
Non-negotiable, exactly. You need rigorous compliance. That means adhering strictly to local AML, anti-money laundering, and KYC Know Your Customer laws. Very important. Plus, they have to meet reporting and disclosure rules. That typically includes filing annual financial statements and providing required data to the relevant tax and regulatory authorities. Keeping precise, up-to-date records of everything, all transactions, all activities is mandatory. It ensures transparency and compliance everywhere they operate.
Okay, so if we pull all this together, the Luxembourg SCSP is basically the quickest, most adaptable route for professional investors who need an EU-compliant structure, one that maximizes that flow-through tax efficiency while giving them huge freedom contractually over how it's governed and how distributions work.
That really sums it up perfectly. It's built for complexity. It can handle everything from those master feeder setups we talked about to global joint ventures, huge private equity drawdowns. That combination, limited liability for the investor, tax transparency for the entity, makes it incredibly efficient for raising and deploying capital across borders.
And that high degree of customization you mentioned, the fact that you can define almost everything in that private agreement, that really sets it apart from more rigid fund structures.
It absolutely does. And that combination of speed and customization leads us to a final thought, something for you, the listener, to maybe ponder. Given the SCSP's pretty much unrestricted investment policy and that super fast incorporation time, letting capital get deployed almost instantly, how might this highly efficient structure start to accelerate or maybe even reshape investment trends, particularly in asset classes that currently find it hard or slow to access institutional money?
You mean things like frontier markets, or maybe new digital assets, or even those large-scale sustainable infrastructure projects that need big, fast, highly customized funding rounds.
Exactly. Think about it. When you combine regulatory certainty within the EU with that kind of structural velocity, you potentially create a really powerful catalyst. So the question is, how does that efficiency fundamentally change the speed and maybe even the nature of capital flowing into those really novel high-growth areas, the ones that are often complex and sit on the financial frontier? It's quite a fascinating look at how legal infrastructure can actually drive financial innovation.
That is a compelling thought to end on. Thank you for taking this deep dive with us today.
Always a pleasure. Glad to be here.